Since early October, Japan's bond market has gone through a major bear steepening episode. It began when Senator Takaichi won the LDP leadership, and it ramped up again this week after she said that she'll dissolve the lower house and call a snap election for early February. Takaichi may be polling strongly, but markets are less focused on her popularity and more on the policy direction that she represents. If you look at the shape of the JGB curve, today's blue line sits well above the red line from the day before she became LDP leader. The long end has lifted sharply, and that's a classic bear steepening episode. Shorter maturities are still anchored by BOJ policy rates, but the further out you go, the more investors are demanding compensation for fiscal risk, inflation uncertainty, and the chance of increased debt supply. Across the JGB curve, the pattern is similar. The red line shows the rise in yield since Takaichi took over as LDP leader. The blue line shows the extra push higher we've seen this week once the election was called. Moves have been greatest at the ultra long end of the curve, with the 40-year tenor breaking above 4% for the first time on record earlier this week. Demand at some recent auctions has been patchy, and there's been a general softening in appetite for longer-dated Japanese government debt, and that's helped to drive the speed of the adjustment. But the latest trigger is a mix of tax cuts and spending. Takaichi wants a 2-year sales tax cut on food, and several opposition groups are talking about a permanent reduction. She insists this can be done without issuing more debt, but for now, markets are skeptical. When the funding story is uncertain, term premia tends to rise. It's not emotional, it's just how bond traders price risk. And you can see that clearly when you look at the slope of the JGB curve. The 2s10s on the left shows that markets have marked up medium-term nominal growth expectations, given Takaichi's reflationist reputation. But an even stronger move has been seen in 2s30s on the right, with a big rebuild in term premium. Investors are demanding greater compensation for holding longer-dated Japanese debt because the fiscal outlook is so unclear. The risk now is for a broader spillover into markets. Most of the damage so far has been at the ultra long end, but if that pressure drags the 10s and belly of the curve with it, financial conditions tighten very quickly. Equity markets start to feel it. Credit feels it. Borrowing costs for households and businesses rise. That's a scenario that policymakers will want to avoid. Which of course takes us to the Bank of Japan. Swaps have moved forward the expected timing of the next hike to around June, with another move fully priced by the end of this year. That's a major hawkish shift from late last year, when only one full hike was priced. But raising short-term rates into a steepening episode comes with risks. It can put stress on yen carry trades and create cross-asset volatility the BOJ will not want to see. The other option is to step up bond buying. That could stabilize yields for a while, but if they act without a clearer picture on the fiscal outlook, the pressure can shift immediately to the currency instead. On the weekly dollar-yen chart, we're sitting near a sensitive area between 158 up to 162, and that zone tends to draw a lot of attention given it's where the BOJ last intervened in 2024. Heavier bond buying could weaken the yen, but more hikes could pressure carry trades. Every choice has a trade-off, and that's the challenge facing the BOJ right now. At current yields, there will be buyers. Some domestic names, some foreign investors looking at hedged returns. But for a more sustained bid, the markets need confidence. A credible plan on how any tax cuts or new spending will be funded. Steady auction demand. Consistent policy messaging from the BOJ starting this week. Right now, the message from markets is very simple. If the government wants to cut taxes or boost spending, it needs to show how it will pay for it. If not, the curve stays steep. Term premium may keep on rising, and the risk of a broader spillover remains. And if the pressure builds in both the bond market and on the yen, the BOJ could find itself forced to act in one market or another. That's not a great place to be. Snookered much?